Hello everyone, my name is Rossana with student ID EMV22792 from Holmes Institute Sydney campus. On this occasion, I would like to present you about income tax applied in a company. The company that I choose is Academies Australasia for the year and the financial statement that I took for this presentation is in 2019 and 2018. Before we have a look further in Academies Australasia financial statement, there are a few terms or concepts that I would like to explain. First of all is accounting profit. Basically, accounting profit is the number or the figures that we usually see in a company's income statement. This number is calculated from revenues deducted from all expenses, and these figures is a result of the calculation according to accounting rules and standard. And we also have taxable profit here. Is a bit different from accounting profit because this figure is calculated from taxable revenues deducted from all deductible expenses according to tax rules. So taxable profit use tax rules as the principles and guidelines, and the number itself is definitely different from accounting profit. And because of that, will result in temporary difference, which is basically the difference between accounting and taxation standards. To make it more clear, in explaining temporary difference itself, we use two common terms, which is carrying amount to explain the figure or the amount calculated from accounting standards, and tax base is basically the number calculated from taxation standards. Temporary difference itself has two types. The first one is taxable temporary difference, which is a condition where carrying amount is greater than tax base, and it will result in deferred tax liability account for asset treatment and deferred tax asset in liabilities treatment. And the second one will be deductible temporary difference, where carrying amount is less than tax base and it will result in deferred tax asset account for asset treatment and deferred tax liability for liabilities treatment. Recognition criteria for the deferred tax assets and liabilities are: the first one is the probability itself for all deductible temporary difference to have taxable profit in the future to be deducted from or utilized against, so it has to be utilized. The second one is the assumption of going concern, where company is believed will keep growing and remain in business and operate. And the last one is taxable income derived from future period and profits from its business. Okay, now we look into a company's income tax expense. Academies Australasia income tax expense in 2018 is 1.666 million, and in 2019 is $1.901 million. And this tax expense is equals to tax rate times accounting income. So basically the corporate rate is 30%. So if you look at the net income in 2019, it's 6.706 million times 30%, which results to $2.012 million. And in net income in 2018 is $6.120 million times 30%, which results to $1.836 million. Those two numbers basically is the number of tax payable reported in Academies Australasia. However, the tax expense reported, as we see in the slide before, is $1.901 and $1.666 million due to few adjustments, which will be shown in the next slide. So the adjustment itself is due to permanent differences and tax balance of controlled entities. But after those adjustments, it is exactly results to the number of income tax expense reported by Academies Australasia, which is 1.901 and 1.666. And Is there any current tax assets or payables account in company? Yes, definitely yes. As you can see in 2018 and 2019 on this table, they are definitely two accounts, deferred tax assets and deferred tax liabilities. However, the company offset those two accounts every year, which results in deferred tax assets for 2018 is $4.014 million and 2019 is $3.906 million. And the next question is income tax payable the same with income tax expense? The answer is no, because income tax payable is amount tax payable that company actually owe to ATO, and income tax expense is amount of tax that company owes during financial period according to accounting standards. So income tax expense is a specific tax that has to be recognized and reported during a very specific period. So there's this timeline here. And is income tax expense equals to income tax paid in cash flow? Answer is also no, because the nature itself, income tax expense is the amount of tax that company owes during financial period according to accounting standards. And income tax paid in cash flow itself is amount of cash used to pay for company's tax obligations. So we can see the clear difference is the nature of cash hold a big difference, as the income tax paid in cash flow reflects how much proportion of cash used to pay income tax paid, but it doesn't mean it's the whole income tax expense for the company. And what is temporary and permanent difference? So basically there's a similarity for these two things, which is results between different treatment from accounting and taxation standards. But the difference itself for temporary difference is these differences will eventually be settled in the future. Meanwhile, permanent difference, just like the name, it won't be settled in the future no matter what, because it's the different applications. For example, donations. If company is doing donation, it will record it as expense in company financial statement. Meanwhile, in taxation point of view, donations is not deductible expenses and will not be deducted from any taxable income, whether in a current period or in the future period. So these differences definitely won't be settled in a future period. So from the discussion from previous slides, we could conclude that first of all, accounting income is definitely different from taxable income due to the set of standards that set the calculations from those two incomes. And we could conclude as well, temporary difference is definitely not temporary difference is different with permanent difference. And income tax payable is not the same with income tax expense, also not the same with income tax paid in cash flow due to its nature. And from the company that I've chose, there is a significant amount of deferred tax asset account. This is because of the nature of the business itself as education institution, where most of the students will pay student tuition fee in advance, which will be unearned revenue, and this will result in taxable temporary difference where carrying amount is greater than tax base. So yes, this is all from me. Thank you very much for your time and your attention. Thank you.